Every single month, millions of people sit down with an extra few $100s and ask themselves the exact same question. Do I throw it at my mortgage or do I let it ride in the market? And what sounds like a simple personal finance question is actually one of the most psychologically loaded, mathematically nuanced, emotionally charged debates in all of money. We're talking about a decision that could mean the difference between hundreds of thousands of dollars over a lifetime. And yet, most people make it based on a gut feeling they picked up from their parents or a Dave Ramsey clip they half watched in 2019. The stakes are real. The math is brutal. And the right answer depends entirely on who you are, what year you bought, and what rate is sitting on your loan right now. Here's where the catalyst lives. Interest rates changed everything. And most people haven't updated their mental model to reflect that. When 30-year fixed mortgages were sitting at 2.8 or 3% just a few years ago, the math was almost embarrassingly clear. Borrow cheap, invest the difference, let compounding do the heavy lifting. But then the Federal Reserve went full aggressive mode, starting in 2022, hiking rates at a pace not seen since the early 1980s, and suddenly homeowners locked in at 6, 7, even 7.5% are doing a very different calculation. Think of your mortgage interest rate as the guaranteed return you get by paying it down, because that's literally what it is. There was a moment, maybe 2020 or 2021, where the personal finance world felt almost euphoric about leverage. Reddit was full of posts about arbitrage your mortgage. Stock portfolios were up 30-40%, and people felt like geniuses for carrying cheap debt while their brokerage accounts ballooned. That optimism has gotten a lot quieter lately. Not because the strategy was wrong then, but because the conditions that made it brilliant have fundamentally shifted. The psychological weight of debt is something the spreadsheet crowd consistently underestimates. And that's not a character flaw, it's neuroscience. Research consistently shows that financial anxiety suppresses decision-making quality, and for many people, a paid-off home isn't just a financial asset, it's a nervous system reset. As Morgan Housel puts it, the highest form of wealth is the ability to wake up every morning and say, I can do whatever I want today. And for a lot of people, that feeling lives on the other side of a zero balance. But let's not romanticize debt freedom so hard that we ignore a century of market data. Because the S&P 500 has returned roughly 10% annually on average before inflation and roughly 7% after. And that is not a small number compounding over 30 years. If your mortgage rate is 5% and the market does 7%, you are mathematically leaving money on the table every single month. You aggressively pay down principal instead of investing. History doesn't repeat, but it does have a very consistent rhythm. And that rhythm has rewarded patient, consistent investors with remarkable regularity. Now, let's kill the biggest misconception right now. Paying extra on your mortgage does not reduce your monthly payment. It reduces your term and your total interest paid. So if you're doing it because you want breathing room in your monthly budget, you're solving the wrong problem entirely. And a refinance or a simple emergency fund would serve you better. The historical lesson that actually matters here is this. Forced savings mechanisms beat willpower every single time. And the question isn't just which earns more, but which one will I actually do consistently for 20 years? If throwing $500 at your mortgage every month is the move that keeps you disciplined and out of lifestyle inflation, then the mathematical inefficiency is worth every penny. But if you can automate index fund contributions and never touch them, not during the 2008 crash, not during COVID, not during whatever the next panic is, then the math of investing wins at almost any mortgage rate below 6.5%. Here's the irony almost nobody talks about. The people most obsessed with paying off their mortgage early are often the same people who would panic sell during a bear market, which means the suboptimal financial choice is actually the optimal behavioral choice for them specifically. And the people most confident about investing the difference are sometimes overestimating their own risk tolerance until the market drops 30% and suddenly they're very interested in the psychological comfort of a paid off house. Know thyself before you know thy interest rate. The practical framework is simpler than the debate makes it sound. If your rate is below 5%, invest the difference aggressively in diversified index funds. If your rate is above 6.5%, the guaranteed return of paying down that debt starts looking a lot like a bond allocation in your portfolio. Between 5 and 6.5, you split the difference literally and let both goals move forward simultaneously with whatever extra cash you have. Position size and process matter infinitely more than which camp you join, and a consistent 20-year plan beats a perfect 1-year plan every time. At the end of the day, this isn't really a math problem, it's a values problem dressed up in a spreadsheet. Discipline, sizing, and showing up consistently are what separate the people who actually build wealth from the ones who just talk about it at dinner parties. Whether your mortgage gets paid off in 15 years or 30, whether your brokerage account hits 7 figures or 5, the most important variable is whether you kept going when it got boring, scary, or inconvenient. And honestly, being comfortable with either outcome is its own kind of financial superpower. You can run the numbers, make the best decision for your rate and risk tolerance, automate it, and then let go. Because obsessing over optimization is its own tax on your peace of mind. Whether you're leaning toward the mortgage paydown, the investment route, or some disciplined hybrid strategy, the next step is just starting. And starting with the right structure matters more than starting with the perfect answer. If you want help figuring out what that looks like for your specific situation, whether it's real estate investing, home contracting work, or finding the right lender, check out our links in the description below.